Welcome to the last chapter in the entire course. This has got to be cause for celebration on many of your parts. In this chapter, we're going to cover cash flow estimation, and cash flow estimation is estimating cash flows for capital budgeting problems, the net present value, internal rate of return, etc., etc. How do we get the cash flow estimations? In the last chapter, they were just given, but in the real world, they're not. And that's what this chapter is about. We talk a little bit about cash flow estimation. We talk a little bit about how to deal with uncertainty. And then other final subjects on capital budgeting. To begin with, the most difficult part of applying capital budgeting techniques is the estimating of any cash flows. If you are a regular company, the steps you'd go through in estimating cash flows for any project. Now remember, these are capital budgeting projects like, do we open a new store location? Do we open a new subsidiary? Do we buy out a subsidiary? Do we buy just a new piece of large equipment that's going to help us manufacture something? Do we open up a new line of whatever? So the very first step that we would look at is going to every department that would have any input in this particular decision-making process and coordinating with them. What do you think our inputs should be? How much do you think our sales could be? Marketing probably knows better than anybody else, although they may be a little on the high side. So we'll have to get some reality checks along the way, but we would coordinate with all departments. We need to make sure that everybody's using the same set of assumptions, and we have to make sure that those assumptions are realistic. We need to make sure that we exclude any obvious biases. Now, the marketing people may say, hey, we can sell 20 trillion of those, when in fact that's not even likely. That's not the biggest bias that you may have. The biggest bias in capital budgeting is probably the bias of, let's accept this project, because if you accept the project, then I'm likely to be the person you'll have be over the project. So the person who is doing the analysis is often the person who, if it's accepted, becomes the leader of the project and therefore gets a raise. And that may be one of the biggest biases that there is. We're going to be looking at relevant cash flows. So once we figure out who we go to and how we gather this data, these numbers, the second big issue is figuring out what cash flows are relevant and which ones aren't, because not all cash flows are relevant to this particular decision. When making a capital budgeting decision, only relevant cash flows should be included. Those would include any cash flows after tax. Now, sometimes there are things that have nothing to do with cash flow. For instance, depreciation. Depreciation by itself doesn't have anything to do with cash flow, because I depreciate some new equipment, but I don't actually write a check. No money leaves every time I depreciate that equipment. When the money leaves is when I buy the equipment in the first place. It's the cash flow that we're interested in, not the depreciation. However, depreciation is one of those that, even though I didn't write a check for it, it can be a tax shield, and as such, we need to account for it. And so what we're going to do is we're going to look at its effect on income first, and after we've seen the effect that it has on income, that will imply an effect on tax. Taxes are cash flows, and therefore will be able to imply the after-tax cash flow effect. I'm hoping that makes some conceptual sense. I'll show you how it works in some examples. We're only going to look at incremental cash flow too. With incremental cash flow, we're looking at the amount of cash flow, how cash flow will change if we adopt a project. We don't care about the cash flows that are happening anyway. For instance, if we are interested in how much will, How much will I have to pay for my office space at headquarters if I accept this new project? And the project may be a whole new line of business. Well, if it doesn't include any more office space requirements at headquarters, even though I may be sending out a check for lease on my office space, wouldn't actually have any incremental cash flow at all. So that brings up a real big issue for those people who have a background in accounting, because accounting, if you have a good background in accounting, you've talked a little bit about cost accounting. And cost accounting, you're trying to spread those costs over all of my income, essentially, and therefore we're going to assign so much of the cost of the headquarters to every new unit. Well, with cash flow, we're not interested in that. We're only looking at incremental or marginal cash flow. That's the only thing we're interested in. Non-cash items in the income statement can still be important, like amortization and depreciation and impairment, because they can affect taxable income, but we're only going to look at the tax effect of those. We're not going to look at the actual expense because they're not cash items. But the tax shielding effect that they have is important to note. And so we're going to pause long enough to take a look at that. So for instance, depreciation and amortization, we're going to be taking a look at how those affect tax, but realize that they have no impact on the cash aside from the tax effect. Now, for the most part, what we're going to be using is an estimate of cash flow. And the way we're going to account for the tax effect is we're going to be looking at net income first. And net income comes after we take out depreciation and amortization. And then those things which are non-tax items, we're going to add them back to end up with net cash flow after tax. So when we talk about incremental cash flows, we're talking about cash flows only. We're not talking about income. I can't stress that enough. We're only interested in the incremental cash flows. Incremental cash flows are the additional cash flow, which can be negative, that occur because we adopted a project. In other words, we're trying to capture the marginal benefit of adopting a project. So, for instance, the only cash flows we're going to be considering, therefore, are those that are different once the project is adopted. Things to include would be these, or not. The nots I've put in dark blue here. So the or nots, when we start with an or not, the first one is sunk costs. This is the example that I gave you to begin with. So for instance, if we have a empty lot next to our headquarters, and we own both the headquarters and the empty lot, and maybe we're interested in developing some new project on that empty lot. So we're going to be looking at the cost of the empty lot. If we were interested in looking at cost accounting, we would include the cost of the empty lot. But we're not. We're saying it's already sunk cost. We've already bought the lot. So that's not a relevant cost at this point because I already have it. Cash outlays already made should not be considered as incremental cash flows. The same can be said for cash outlays that would be made anyway. Now, it doesn't mean that it's not a relevant cost for costing purposes, but it does mean that it doesn't make any difference for our decision as we're making it on this instance. Now, unlike what the cost accountants will tell you to do, we will also include things such as opportunity costs. And an opportunity cost would be like, if I had my empty lot next to my headquarters building, if I've been using it once in a while to sell parking spaces in downtown whatever city you want to be in, and I've been gaining some money by doing that, all of a sudden I'm going to have to forego that money if I build something on that property. that would be an opportunity cost, and actually have to put that in as an opportunity cost or account for it somehow, and I'll show you how to do that in a little bit, I think. At least conceptually I will show it to you, whether I say this is an opportunity cost and here's exactly, no. The concepts are there, and that's kind of what I've been hoping to do all semester, although people tend to want to follow these as if they're a cookbook. They're not. The final one that I'm interested in looking at is externalities. Externalities we want to be able to capture as well. So for instance, and this is one that I usually will talk about because I usually wear a bow tie, and so let's assume we have this bow tie manufacturing company and they decided to look at a potential new line. And that's the project that they're considering. Well, the project may be belts, they may be suspenders that match the bow tie, let's say. So let's go for suspenders that match the bow tie. And if you're making suspenders that match the bow tie, well, that may actually make people who weren't buying your bow ties more interested in buying your bow ties, and therefore your sales in a product that is not the new project go up, and we would want to be able to capture that as well. When we're talking incremental cash flows, we're talking about all incremental cash flows, not just the ones for the suspenders or the belts or the whatever. We're talking about all externalities, and we're talking about all opportunity costs, and we're talking about all incremental cash flows. The other thing to note, because we're going to be doing this with some real, we're going to be doing these not with real data, but we're going to be doing these with some story problems. And this always threw me off the first time I got out of school and was trying to apply anything. I'm going shipping and installation costs. What do I do with those? Because I'm not an accountant, I don't realize that you're going to book those. So when I buy a huge new chunk of equipment for my factory, what do I do with the shipping and installation costs? Do I expense them? Or do I put them on the balance sheet and depreciate those costs? And the answer is the latter, actually. I put them on the balance sheet as part of the costs of the equipment, and I depreciate it because I can't actually use the equipment without incurring the shipping and installation costs. And so I'm going to include those as well here because they're actual costs. And because I know that I'm going to be depreciating those, I'm going to have to adjust my depreciation accordingly so that I can recapture or at least have a better estimate as to what the tax effect is going to be. Inflation. This one is one that accountants never talk about, but we have to talk about because our cost of capital, all of our cost of capital, all of our weighted average cost of capital are after inflation. In other words, there's an inflationary expectation embedded in all the costs of capital. Therefore, when we're going to be doing these capital budgeting problems, we have to take into account inflation. That means we're going to have to take it into account in the revenues. We're going to have to take it into account in the expenses. In general, the first few examples I'm going to give you, we're not going to take those into account because I need to ease us into these because these story problems will be just too ugly otherwise. Incremental financing costs include any loan origination fees, any debt or equity flotation costs, meaning extra costs. If I have to hire an investment banker, how much are they going to be charging? The reason for this is those extra costs are typically not included in the weighted average cost of capital. However, we do not include any interest or interest expense kinds of costs at all, because the interest expense is included in the cost of capital already, and we don't want to count for it twice. Identifying incremental cash flows. Here's what we're going to do. When we get an example, we are going to break the example into 3 different areas. I find this works a lot easier because if you don't, then you'll get so much data you go, I don't even know where to begin. So I find it easier if students will break it into 3 different sets of cash flow. And then as we break it into those sets of cash flow, then it's easier to deal with. So the very first one is what's called initial cash flow. These are just cash flows that are occurring at the beginning of a project's life. It's what it takes to get us up off the ground and running. So for instance, any new equipment would be included in that, any new installation, shipping, any working capital outlays up front. We'd have to be looking at all of that sort of thing. Those are just getting us up and growing and off the ground. And I'll go over those in a sec. I know I'm going to go over these twice, but I find people learn it better that way. Okay, so bear with me. Second, operating cash flows. Operating cash flows are what it costs just to keep the project up and running. These are just ongoing costs and revenues, so costs and benefits of running the project. This one should yield us positive cash flows in general over the life of the project. Otherwise, it's probably not worth looking at. And then finally is my favorite cash flow, because then I get to do a Arnold Schwarzenegger imitation. It's terminal cash flows. Okay, these are terminal cash flows. They're the cash flows that are associated with terminating the project. These are the ones that happen at the end of the project. Okay, yeah, it's been a long semester, so you should be going, okay, this guy's weird. That's all right. You'll live. Notice I put T0 in the first one because they only happen up front, T1 through Tn on the second one, and Tn only on the last one. So if we're looking at that cash flow timeline, that's the way they're going to be looking. I'm going to construct these in Excel so that you can see the T0, T1, Tn through Tn, and then we'll break them up separately just so you can see how to do this, which means we really ought to get... Oh, first off, I have to talk about each one of these individually, and then I'm going to give you an example, a simple example up front, okay, just so we can play with these. So the initial investment outlay, this is the T sub 0 outlay. These are incremental cash flows at the beginning of a project's life. If it's a replacement decision, we're going to take into account the cash flow associated with disposal of the old equipment, net of taxes. We're going to include any net change in working capital, such as accounts receivable, inventory, etc., etc., etc. Now, when we say net includes net change in working capital, I usually just assume people know what I'm talking about because I've spoken finance language for a long period of time. But then I look around and see dazed looks on people's faces, so I have to define working capital. Working capital isn't just current assets minus current liabilities. That means any change in current assets and any change in current liabilities associated with this new project will have to be accounted for. Typically what companies do is they can get what's called a working capital loan. Well, that just means what they want is something that they can use for cash, essentially. But cash is a current asset. And so to increase their current asset by a certain amount increases their current liability by that same loan, in the case of the loan. But in the case of a new project, we may be saying we need to increase our accounts receivable, which means we're not going to be, when we make a sale, it's not going to just increase our sales revenue, it's going to increase accounts receivable by something. We may have to increase our inventory if our company has inventory. We may be increasing our accounts payable as well, because I don't have to pay for everything out of pocket. I may be paying for some of it put it on my tab, okay? So once we look at all of those, we're looking at current assets minus current liabilities. So we may increase accounts receivable, inventory, and accounts payable. But notice the accounts payable will reduce the amount of working capital needed based on my little equation. Current assets minus current liabilities. Operating cash flows. These are the T1 through Tn cash flows. These should represent incremental operating cash flows as a result of adopting the new project. These can be simplified as changes in cash revenue, changes in cash expenditures, changes in taxes. So you can actually come up with a sort of an income-ish statement that, instead of looking at the actual income statement, is looking at change statements. This simplified form, and yeah, I put quotation marks around the word simplified with my fingers. You didn't see it though. Makes more sense when we're considering things like replacement decisions. If we're looking at a new project, just brand new, well then the current project is nothing and the new project is something. And so we take our something and minus the nothing, and we just get the something. So that simplified version doesn't work as well on the new project, is what I'm saying. But I'll show you one of those anyway. And finally, the terminal cash flows. Terminal cash flows are those cash flows associated with winding down the project. Terminal cash flows should include final disposal of the project. That means cash flow associated with disposal of any equipment. So if we have to salvage some equipment, remove some of the equipment, and in some instances, if you were doing some strip mining, that may include reworking the environment so that you don't notice that nobody will ever know that there was a strip mine there. Tax effects due to recapture of any depreciation expenses or impairment of any of salvaged equipment, etc. We'll talk about some of these as well. We're going to be returning the firm's operations to normal, which basically means if we needed more inventory, hopefully we'll sell it and not replace it. Therefore, selling it and not replacing it is like I get money put back in my pocket. It cost me a certain amount to begin with, but then I put it back in my pocket at the end because I'm selling it and not replacing it. And then I pay off all my accounts payable. So we're doing just the opposite of what we did to begin with. And so quite often we'll just say, whatever I did to begin with, we're doing just the opposite with the opposite cash flow sign. In other words, if it was an outflow, it's a negative. If it's an inflow, then it's a positive. And so with the inventory, it cost us money up front, so it was negative. At the end, I sell it off, but I don't replace it. Therefore, it becomes a positive. So I'm hoping that makes some sense. If you watched my hands, it would make more sense, but you can't see my hands. So let me give you an example. Now, this one's the simplest example that I can think of, but it's going to look like a train left not just a train left Chicago doing 70 miles an hour, but a train wreck left Chicago doing 70 miles an hour. So I'm going to introduce it here and let you chew on it for a minute, and then I'm going to show you how to solve it in the next video, so that these videos don't get too long. So here's what it looks like. You work as the financial manager of a natural fertilizer preparation and packaging plant. Now think natural fertilizers. The firm is introducing a new product which, although natural, is also packed with added plant nutrients such as minerals and vitamins, etc. To convey the message of high-content fertilizer, it goes by the name of Full of It. Okay, natural fertilizer and Full of It. Okay, this new product is only going to be offered over a 5-year basis. To produce this new fertilizer, you will need new equipment, which will cost $150,000 base cost. The shipping and installation will be $20,000. In addition, you'll need to increase inventories by $6,000. Of course, it's inventories of, well, crap, because it's natural fertilizer. Your research has led you to believe that you can sell 25,000 bags of high-content natural fertilizer for $9.50 per bag. The cost of the contents, packaging, and shipping are expected to be $4.50 per bag. The annual fixed costs of the venture are expected to be $40,000. For simplicity, we will assume the cost of the project will be 100% depreciated over a 5-year life of the project using straight-line depreciation. Further, the cost of removing the equipment will approximate the market value at the end of the project, so it will essentially be worthless on the books and in actuality. We will assume a tax rate of 34%. We will also assume a weighted average cost of capital of 15%. And our question now is, should we accept this new project? I've given you all the relevant information. I want you now to turn this into a capital budgeting problem. Now you see why we talked about all of this stuff. Now we get to apply it all. I'll let you chew on this for a little while, and then meet me in the next video where we're going to give you the solution. I'm hoping you're on the edge of your seat.